In today's podcast, Trisha disrobes.
I did not disrobe. I just took off my green jacket.
How about that for a teaser? It's March 17th, 2021, St. Patty's Day, and we are here today to talk about China, the Chevron Analyst Day, some oil price stuff, and Joe Biden's policies, which Trisha just loves.
Inflation, oil prices, and we're also talking about the awesome IEA oil report that came out today, which has stirred a lot of controversy if you've seen the forecast. But we're going to start with St. Patrick's Day because we've been talking about drinking Guinness on the podcast for actually probably every episode and all the froth on the market. And I think given the Fed's and Powell's statements they have not cooling anything off, it's perfectly timely.
Oh, that's brilliant. And we also, every St. Patty's Day, my family drinks to my mom being 36 years in remission from breast cancer. So here we go. Frothy market, and to my mom, Sarah Bellamy, awesome. 73 today.
Also, so I was grumpy with Ethan because he showed up late and he recovered himself well because we're not just drinking Guinness, we're drinking nitro cold brew coffee. And if anyone knows me, of knowing that I'm a coffee fanatic, and if they know me from my past, my London School of Economics days and stuff, I love Guinness. I've always loved Guinness. I like Coors Original too.
And your Twitter handle is?
Trisha J Coffee.
There we go.
But my parents, we as tradition, we drink green beer. So later I'll be putting droplets of green dye into my Coors Original. But this is nitro cold brew coffee, and it is it's not bad, is it? Pretty damn good.
It's pretty good. I like it. So let's dive in.
Yep.
Where do you want to start? China or oil prices? I
think we should start with oil prices and just how our oil prices being too hot to handle. And, Robert and I talked about this in the last podcast, but
the Robert Norton
who stepped in for you while you were on vacation.
I mean, he tried.
Yeah, he did try.
He is actually a very smart man, besides being extremely handsome. Mm-hmm. All the ladies love him, but he's married. So there you go.
He is married.
All right. Trisha is not, by the way. We can get into that later. Yeah, the key to Trisha's heart is don't bring her flowers, bring her coffee and beer.
Or coffee, beer together. Yep. Yeah, and that gets discussed quite a bit when I did the Digital Wildcatter podcast, which hasn't been released, and it was just Jake and I talking, and it got really personal, and there was a lot of questions about I
can't wait for that. Jake Corley is the best backward baseball hat interviewer in media today.
He is. He makes it really.
What do you expect from a Marine?
Easy to talk to and casual. So, okay, oil market. We talked before about this being too hot to handle, and I think given the inflationary pressures and everything we're hearing, mortgage rates, I just checked with my mortgage guy today. If you looked at CNBC today, it was a 30-year is 3.4%. And if you were to go to a mortgage guy or gal and get a mortgage today, it's 3.45%. Many of you have probably were in the refi craze if you had a house and probably were able to refinance sub 3%, which was at rock bottom record lows. 3.45%, by the way, is not that high in terms of a 30-year mortgage, historically speaking. It's not that bad. However, given what we've seen in Denver, with the houses going, it's bananas in pricing. We were talking about lumber pricing today. Everything's going crazy, and oil prices are a huge piece of this sort of inflationary thing, in addition to copper and metals and minerals and everything. And this does seem to always come back to...
And we should also say that the stock market is in a bubble.
It's definitely, I think it's
in a bubble, no question about it.
Well, the whole, I didn't even know what these things were. The digital art that's going for, I'm sorry, what am I going to do? I'm going to put on my computer up here and stare at it? What the F is that? Digital art. So that's going for millions. That's when you know where that is definitely .com. Digital art is total crap. And then the tokens thing, is it it's digital art, the tokens. So Dogecoin, I kind of get the Bitcoin thing is fine. It is what it is. I can see how people might want to value as a separate store value given a hedge against inflation. We're seeing that in gold and everything, but this is just not the digital art. And then what's that, EFT, or it's called NFT? Is that the digital art?
Yeah. Well, the concept, if you saw or read Ready Player One, is that we're going to be living in a virtual world and people are going to want virtual artwork. And if you look at the froth on the art market, then that translates into the digital economy. So I thought crypto was the best example of, and I'm talking altcoins, I thought that was the best example of froth and too much liquidity in the marketplace. But it turns out that the real answer to that is NFT.
Yes.
So fake digital artwork, people selling tweets. And I tweeted, actually, that the best battle going today is Peter Schiff versus his son over crypto. So check that out if you haven't already. It's very entertaining.
I don't even know what he's talking about right now. So.
Well, you have a life and don't do Twitter like I do. But
No.
I thought we were going to talk about oil prices here.
Yeah. So talking about oil prices, this whole question, like, are they too hot to handle? And I think, I was talking to my former boss today in DC, and we were just saying, if prices are pushing $3 a gallon, you're feeling, this is literally a taxation on people. So we just passed this nearly $2 trillion stimulus package, which again is a huge component of why we're seeing inflationary pressures. Nobody was that concerned about real inflation until your economy is doing well. It's all coming together from this boom in thinking there'll be a huge boom in electric vehicles and in the auto manufacturing sector, and particularly in batteries. And then there's also then you have the stimulus measures, and you have this big push on the electric vehicle side. So there's this hope, and so copper's going up and everything's going up, and obviously demand for oil and gas is going up. That's hence why we're seeing oil prices go up. But we also have all these barrels sitting on the sideline, and then this stimulus package is being $2 trillion, and the economy is looking pretty good. That's why everybody's freaking out and questioning Powell so hard today, because they're wanting to know when they're going to start moving. They're going to start reducing quantitative easing, and they said. And
the answer is they're not.
Well, they said they're going to start on the front end of the not on the back end. So they're going to start reducing the asset purchasing to some degree. It was very muted. It was still very, very dovish.
But
and
very dovish.
They kicked out the whole, and they kicked out they said they want full unemployment, which they broadened that phrase of employment, and they're okay with letting the economy run a little hot with higher inflation. And they kicked it out till another year. So they basically, it was kind of open in 2022. We could see a rate hike. Now it's like 2024, which I think it's one, the Treasury is already doing it for you. The yields are already going up. We're already seeing we're already seeing the market do it on the Treasury side. So maybe the Fed doesn't have to do anything, but I think they're going to have to do it anyways. I think.
Okay, so tie this back to oil for me. What does this mean?
Well, oil's a component of it, of that whole inflationary piece, and people are feeling it. It's one of the first things that they're feeling of when it's, as you've mentioned before, it's a regressive tax. I mean, this is a tax, and it actually hits your lower income most. And India has already come out and said forecasters and analysts are saying that India, they're revising their GDP forecast because these are inflationary, in addition to other metals and things and commodities. India's seeing this very high oil prices, and they've been pretty vocal in calling OPEC to say, come on, let's loosen up the taps a little bit. And I think what we're going to have to see, Paul Sankey made a comment on CNBC this week.
Crude Gusher.
Crude Gusher?
That's
what?
his Twitter handle.
Oh, yeah. Anyways, I don't know his Twitter handle because I'm obviously not on Twitter enough. But Paul Sankey, I just know him because he's on all the earnings calls, and we saw him on the Chevron Investor Day. Anyway, so he got on CNBC and he said it would have been really nice to see OPEC bring some barrels back on just to see how the market would have handled it. And I agree. And so most analysts did not, the March 4th when OPEC Plus said they were going to keep barrels off the market. By the way, they didn't keep all the barrels off the market. So I think the Saudis probably worked closely with the media and said, don't let this out very much, but they didn't keep all the barrels off. They allowed Russia to produce another 280,000 barrels per day, and they allowed Kazakhstan to produce another 40,000 barrels a day.
Allowed Putin to do anything is hilarious.
Yeah, so I mean, they're doing these barrels. It's not a ton of crude, but it's enough to be like, okay, we'll make you happy. Now, look, this is also the first time in history, not the first time. This is the first time in very recent history that it's never been so profitable to cheat. So we have seen incredible OPEC compliance, and part of the reason we've seen such incredible OPEC and OPEC Plus compliance is because they've changed the terms, right? You're not restricting condensate production. So in some ways, the market, they've been able to offset crude production by increasing condensate output. And that means they can literally go to their natural gas reserve and they can increase natural gas production and increase condensate production. So it kind of works out, which also tells you that the market's done pretty good in absorbing those barrels. But what's interesting is that all these countries now are looking at this, and you're looking at $70 Brent. It looks nice. It would be a good time to start eking out a few more barrels because their budget deficits are looking so much better. I mean, the Saudis just went to the bond market and were able to borrow at negative interest rates. I mean, it's really healed up the Middle East in a real way. And I think this is kind of what's fascinating is if you follow what the investments going on in the Middle East, and if you follow all that, yes, they're investing in renewables and they're doing some solar and they're talking about hydrogen and green and blue, different, colors of variations of hydrogen, which we can get into. But it's interesting because it does seem like a very different world than the whole very deep energy transition stuff that we hear on a, daily basis. And then if you're in the energy community and you're studying this stuff, you're kind of inundated with it. And I took a liberty to dive as deep as I could get into this energy transition thing, this is the dialogue that I would like to get into.
Very surprising. But before we get to that, a couple things. Let's get back to your core thesis on what the right price for oil is, number one. And number two, how high does oil go how high does oil have to go to start impeding demand and destroying demand because prices are too high?
I think it's already to a point where it's impeding demand growth in the emerging markets. So you're already at a point where China and India are where the globe is still in recovery mode. So as well as the globe is doing in getting out of the pandemic, and I think as we've talked about significantly on pent up demand in the market, it still is it's a benefit if prices were lower, and lower for longer and more stable is going to be better for long term demand. And if you're an OPEC country and thinking about this, so letting oil prices going to 70 right as you're recovering out of the demand. Maybe it's doable, it's survivable, people are going to pay for it, but you may not know what true demand could have been like if oil prices had stayed at 60 or if oil prices had stayed at 55, because that uptake might have been more significant. And all this talk that's coming out on reducing that, nobody on the energy transition side is even really talking about oil prices in the way that technically the way that they should be. But I think the right prices, I'm going to be wrong. I think I was happy that I was really right about oil prices in 2020. Obviously, I think they're too hot to handle now. Doesn't mean they can't keep going up. Doesn't mean that OPEC Plus can come out next month and say, hey, we're not going to put any barrels back. We'll let Russia have another 100,000 barrels a day. We'll let a couple countries have a little bit, but we're not going to add. And if you look at how the recovery is done in Saudi Arabia, I mean, the Saudis have increased their VAT tax, but they've seen inflation because of it. And I think I mentioned that in some previous podcasts, but that's not good for their economy.
Do you think so? Some of your clients, and you can just talk about who they are or not, but probably not, but you service some OPEC clients. And one of my questions is, do you think that they are testing U.S. shale to see if our rig counts start spiking to take advantage of these new prices? Or do they believe that the companies actually are going to at least attempt to live within free cash flow and not overspend CapEx?
So, I have worked with OPEC. I've briefed OPEC countries and I've worked with some in the past, but
you don't have to downplay your skills.
I think that, I don't think they're currently testing shale. I think the interesting stuff, if I've been following a lot of really recent work from the Oxford Institute for Energy Studies on the energy transition, and a ton of stuff they've been doing on perspectives of OPEC players in Russia. And I still think the Russians are very off in that they have this view, that oil prices need to be $70 a barrel for shale to work. Well, shale's been coming back, and I just checked the Permian rig count. We're at 220 rigs in the Permian Basin, and so it's recovered nicely. We had this dip in New Mexico after the moratorium scare, and then it kind of has picked back up again. And they are misreading. I think they're misreading the U.S. The one thing they are talking about more, and OPEC is the Saudis and OPEC are talking about, is the constrained regulatory environment. So Biden has sort of just given them a huge gift, and I think it's given them a lot of more flexibility. I mean, we're at 11 million barrels per day in the U.S., and that has given considerable flexibility for OPEC Plus to maneuver right now and to do a little bit more, because we haven't brought these barrels back along very fast. I think that people are there's a risk that the market is underestimating the ability of small players collectively to make a dent in production. And when we see 220 rigs, all these rigs are, and everybody says, oh, we've tapped out on drilling efficiencies. Like, I'm sorry, Diamondback mentions it in the earnings call that how long their laterals are. And I just double checked it on my data, and it was incredible because they do beat.
How long are they now?
They have some areas in some counties that are north of 10,000 feet, and they crush it. They basically said, well, we're getting the speed at which they can drill them and the lateral lengths that they're doing are longer and the speed is faster. And so if you take some of these operators and you just look at the benchmark for, what is the average by county, and then you pull up like a Diamondback and some other big players, they far exceed it. And that's pretty significant because those incremental efficiency gains taken together, they're really, really meaningful. So your barrel per foot can stay flat, but if you're still extending that lateral and you're still getting that, you don't see the diminishing marginal returns. And some people then ask me, well, that doesn't, they're going to see the diminishing marginal returns. Well, when they do, they'll stop. They won't go that far. They'll stop. They're about saving money. If this doesn't make economic sense to them, they're not going to do it. So that's just an important component. And I think that the Permian is probably going to surprise in some ways to the upside this year, because we'll get to it surely. But on Chevron's Investor Day, I mean, they really did emphasize this short cycle that they're pivoting back to the Permian. COVID was one thing. Now they're back in the Permian and they're back in all unconventionals. And this was going to be their short cycle growth story.
Okay. So let's go to the energy transition, because I know you're itching to talk about developments in that area. And I know you have a lot of contacts in Washington, some of whom don't entirely share your political persuasions, being a Northern Colorado, Wyoming type of girl. So what do you think is happening in D.C., and is there a disconnect with real world energy and D.C. policy right now?
Well, this should be a bit of a discussion because I want you to chime in on this as well. But I think I told Ethan I wanted to bring this up because I think that the terms energy transition are paid, and you hear it in a lot of Digital Wildcatter podcasts and stuff, but I think it's paid lip service, and that nobody's defining what energy transition actually means. Those are two words that it's just thrown out quite a bit, and we say them in the oil and gas industry, and we're like, oh, it's the energy transition, and no one's defining it. And I think it's really important to understand where it's coming from. So I have actually, when I get frustrated with things, I typically just research my way through it until I feel more comfortable. And so I have spent a lot of days on hydrogen and what's actually happening in China, and are they using all that coal?
But do you have a good definition of energy transition?
I think it changes between who's saying it. So simplistically, energy transition is meaning that we are transitioning from fossil fuels to another form of energy. What the existing world that we live in is we are using fossil fuels, coal predominantly, still in the power sector, but we have increasingly amounts of wind and solar, and we have natural gas. I don't even know if you would define that as a transition as so much as you're adding renewables into your grid. And now this talk right now and the executive orders with regards to electric vehicles. Now, 2020 was a bang up year for electric vehicle sales, but another thing was a bang up year for sales was internal combustion engines, used internal combustion engine sales, which is really important when we get into this new IEA report that they talk about, because they disregard the fact that, you and I may want we may want an internal combustion engine in the winter in Colorado or Wyoming, or God forbid, North Dakota, that we may want a gasoline vehicle to drive around in the winter because the battery Tesla may not quite have the range issue, the range. And in the city, when you don't drive around, it doesn't matter. But actually in the country, I mean, I was thinking of driving home for Christmas. Like, it's a huge deal. You have to have that. Like, people don't shut down the way we do in the cities. So I think the concept of energy transition, and I digress a bit, is this, you're moving from one source of fuel to another. But it's been the COVID-19 collapse in oil prices was the catalyst. And I had been thinking about that a lot before, of what was really driving it. But it was actually, I think, from an academic perspective, when I looked at Oxford Institute for Energy Studies just did this huge report. They put out this forum thing, and it's all on basically the geopolitics of energy. And it's essentially, they call it the out with the old and in with the new, but it's basically all this energy transition. They go through every level of it. But it, to me, did strike me, especially for Oxford, as being very academic. And I know some of the policy people in there that wrote this stuff, and I was shocked at how hopeful and wishful thinking it was in terms of a geopolitical standpoint, and how naive it was in thinking that energy security issues would be reduced because we wouldn't be using as much oil. And that, to me, was really shocking, is that the academic perspective of the energy transition assumes that we're just going to rapidly decline our oil consumption. And the IEA, the report came out with that today, also assumes that. And that rapid decline would mean that, we would, with next year and the year after, we would just be uptaking massive electric vehicles and declining our use of oil. And even if you were to do that in the developed world, it's very hard to see that like happening elsewhere. And your costs right now on these electric vehicles, let's set aside the massive inflationary pressures we're seeing on batteries, which are going to be translated into the cost for electric vehicles, and the semiconductor issues we're having and just the chips for regular vehicles. All this stuff is going to be inflationary vehicle. When you're going to go buy a new car, it's going to suck because it's going to be very expensive. And that does not do well for uptake. But from an academic perspective, I think the biggest shocking point was that they basically used the COVID-19 price collapse, the price collapse and the demand collapse. So, probably at the bottom of it, we saw, or the height of it, we saw a 40 million barrel day collapse. And that was used as sort of this premise of this is what it could look like. And I'm kind of theorizing a little bit, but in all my research, that's what I'm seeing is that this 40 million barrel day demand collapse was like, this is what it could be. And, we could be, and that's where this whole mental thinking of coming out of this cleaner, greener, and stronger, is like, this is what it could be. And that was when you shut the world down. You literally stayed in your houses and you didn't move. Like it was horrible. I mean, from every perspective you can think of.
But nature's healing. That was the rallying cries. People are stopping their activity, but the world is getting better.
People were dying, and the world was healing. I mean, so it's an extreme. And I think if people are using the COVID economic collapse, the COVID economic shutdown, which was a chosen force-induced economic crisis, as to thinking about that's how the energy transition is going to look, you're way off base. Like
let me play because I believe that Americans would revolt if they had to pay German power prices, as just one example. In terms of choice and saying, hey, I'm going to force you to buy an EV versus, buying an ICE vehicle. That's one thing. There's also a battle coming, basically having California level CAFE standards for the entire United States. I think that one of the reasons the Biden administration is being very aggressive now is because we're on the tail end of the shale boom and we still have excess supply. We haven't recovered enough. And we're far enough away from the next presidential election that you can push through policies that might not be politically appetizing when that comes around. So I think that's part of the reason for the speed and why we're going to see a lot more on that front. But with respect to the specific energy transition goals that we see arising in the IEA, for example, it looks to me like they are starting from the premise that we are at net zero at 2050 and working backwards as forecasts. And there's a huge disconnect between what's actually happening and what actual consumer preferences are and that goal. And that's where the policy and sort of academic conundrum comes from. Are you seeing the same thing?
Yeah, and I think that's what's concerning to me is that, look, as people in this business, you all have to be humble. And I talked about this with Robert in the last podcast, was that both Boston Consulting Group and
that's a problem for him.
What?
The humble thing.
Just
take it.
So both, it's also a problem for you.
Touche. Keep going.
Anyways, so Boston Consulting Group and BP, as we mentioned in the last podcast, had in the IEA, IEF, OPEC meeting in Riyadh in February, they had both said explicitly that the market was misaligned in terms of understanding where ESG was at and, the market investing in it, and then where actually oil investment needed to be. And it frustrated me because I thought that both these entities and Boston Consulting Group, I'm not ripping on them so much as BP needs to do a better job of coming out and explaining that then to analysts and to forecasters and to people on Wall Street of what's actually going on. And the problem I have with it is that nobody is doing forecasting. And all of us, if you're in the business, you have to be humble because your forecasts are going to be wrong. I pride myself when I do a 2-year forecast on production that it's usually pretty bang on because I have decent scenarios and I know what I'm doing. But it's a 2-year forecast. It's pretty short. And even that has errors. And I know I'm going to be wrong. And when you work with clients, you basically give them a range. And an economist gives you 20 different answers for everything. That's just how it is. The thing I'm having trouble with is the IEA last year when they came out with their big report had said, and they were in line with BP, one of BP's scenarios on peaking demand basically in 2019 or roughly around there. And they said that we want to emerge from this cleaner and we want to emerge from the crisis cleaner and greener. And that's fine, but it's not fine if you are the International Energy Agency and your job is to be using data and telling the world what's going to happen. And it seems like there's a problem there if they're advocating now versus if they're giving out data. There's very few reliable sources, and even IEA doesn't have a clear line of sight on OECD, which is your developed country stockpiles. So they show you have to pay several thousand a year, but you can get the monthly report, which is what I have. That monthly report that shows you the OECD stockpiles. If you follow the market, I mean, the banks are all over the map. Are we doing a stock draw of 1 million barrels a day? Is it 2 million barrels a day? Some banks think it's 4 million barrels a day. It's a pretty wide range. We don't even know. You know who has data that's open and granular? It's the US. So the only thing you can actually bank on is Cushing Stocks Weekly, which came out today. Like, if you want to know, we have it. So people focus on that. I have another side comment on companies maybe being penalized, US production maybe being penalized for actually showing the carbon, because we're going to have the data and no one else is going to show it. But it's really important because the International Energy Agency, this IEA thing, and so I don't think it's public. I think I tried to share it with Ethan and I couldn't because I had purchased it.
No,
but
don't say that. Don't violate the terms of use.
I think I was talking to him about it. Anyways.
There we go.
Okay, so the oil demand data, and everybody's talking about it. It's on Twitter. It's everywhere. So just Google IEA oil report oil 2021, and essentially what it looks like is they show that we go back, we dip, and then we come back, and then they show two scenarios in which they say their world energy outlook. They have a sustainable development scenario, and then they have a net zero by 2050 case. And within the sustainable development scenario, you have to basically be at 92 million barrels per day by 2025. So we were at 90 for averaging for 2020 with the COVID crazy collapse and the shutting down of the economy. We were averaging 90. So basically, in 4 years from now, we have to repeat that again.
Not going to happen.
Roughly. And that's kind of insane.
It's not going to happen.
To say that's just the easy scenario. Then the real wicked one is in 2025. And get to 2030. It's ridiculous. And by the way, they're talking about net zero 2050, but we have a 2030. So 2030, the easy case is the sustainable one, is you basically drop down to 87 million barrels per day, which is, it's just, that's 2030. In theory, maybe you could see something that doesn't look as unrealistic as the near term, but the net zero scenario is under 80 million barrels per day by 2025 and 65 million barrels per day by 2030. These are insane numbers. And this is not because I grew up around the industry and I'm advocating for it. This is just math. And this is the data of that pre-COVID, we produced 100 million barrels a day of oil and we consumed 100 million barrels a day of oil. So let's just pretend that COVID happened and we permanently have shaved off 5 million barrels per day and we're at a 95 million barrel world. That's what most guys would the skeptics would say where we're at. Okay, we never recover to that. You have to shave off so much from that in a world that's already not flying and stuff. So that means no one ever gets to fly again because you would have to curb jet fuel. And they say if you go through the numbers and you go through the data, they do bank this on IMF's data. So they say that IMF basically shifted the trajectory down and basically back up because of COVID, that we have this permanent collapse. Historically, we also have done a poor job in correlating GDP and oil growth. And we've also done a poor job in perfectly, analyzing GDP growth. In some countries it does more, some countries it does less. We've done a poor job thinking of population growth. Like, we're assuming we're going to have a lot of population. We could be wrong on oil demand there. The data just came out. Did you see that in France was wicked? Like, nobody had children in we thought people were having children in 2020, but it turns out a lot of people aren't.
That old fable about the New York blackouts producing a population boom, that did not happen in 2020.
Yeah, so which was shocking. So that's bad for oil demand. That stuff's very real. But the point is that if you go through the data and you go through all these things, the amount of electric vehicle sales skyrockets in a very short period of time to 60 million sales. And there's a great Platts, I think one of their future energy podcasts is on auto market. It's really good. I'll find it. I'll put it. We'll tag it on this, but great podcast to listen to. And they have a few people that are talking and they're basically saying, hey, this was going to be the bang. 2020 was supposed to was supposed to be the bang up year for auto sales pre-COVID, before we got into all COVID. And they were expected to go hit north of 100 million auto sales, right? And, EVs were supposed to be some chunk of that. And then what happened was COVID happened and we had a collapse, and we did have record breaking electric vehicle sales, mostly from countries which had subsidy, like European countries and some from the US, largely on the back of subsidies. But we also had record breaking used vehicle sales. And that is just I think the New York Times had an article, or not even an article, it was a swipey thingy last week that basically shows you the cars and how you would have to rid all the cars off the road. So essentially, you would have to come to my house and get my truck and get your vehicle outside, and you would have to take them off the road and then force us to get a new. I don't even drive that much, but I mean, you would have to force us to get an electric vehicle to just change that. And I don't think that's going to happen in America. I don't think that could happen anytime soon. And I think that at least 50% of Americans, and actually people that are people that even support a lot of this stuff, most of them have a internal combustion engine vehicle, and they also have an electric vehicle, as most consumers with electric vehicles don't usually have one car, they have two, because they still have range anxiety.
Right. So that brings up, I was on Clubhouse in an oil and gas room today, and the moderator was talking about the embedded hypocrisy. And we were talking about the North Face incident where they, number one, wouldn't sell jackets to a firm called Innovex. The CEO, Adam Anderson, wrote a letter saying, hey, look, your inputs are all poly and plastics that come from the oil and gas business, and yet you're hypocritically saying you won't make jackets for the business. And I think, look, when push comes to shove, everybody who wants to use oil and gas products wants to keep using them. For example, there's a group called Protect Our Winners. And I look, and it's a who's who of outdoor gear manufacturers. And I went through the list, and it's, the North Face and Patagonia and Smart Wool and, the manufacturing, distribution, and it's ski. I mean, imagine a ski area that, nobody gets there without fossil fuels. The lifts don't run without some sort of electric power that comes from a grid that's reliable.
I've never been skiing, but do you ever have
I wouldn't say that. You live in Colorado.
I mean,
you can't say
I know
that.
it's really bad. I go, I snowshoe and stuff, and I've sledded a lot and taken a lot of 4-wheelers on the snow, but I've actually never been snowmobile, but never been skiing. Do you ever get off the slopes and go to a fireplace with either burned by wood or natural gas, or what the big boom is this year is propane heaters, which is really exciting. Like everybody goes up. So I imagine in ski towns there's a lot of use of natural gas. Yeah,
it's very energy intensive. But the broader point there is not to bash POW or to bash any of these companies specifically, because it's a societal problem. I mean, the best example is, for me, the biggest climate hypocrite on the planet is Leonardo DiCaprio, right? He rents giant yachts to put his models on in the Mediterranean. He's on his private jet all the time, and yet he's out talking about climate change, and he's got the biggest carbon footprint of any human who's ever lived, right? So that is emblematic of the inconsistency in which we think about the use and take for granted the use of oil and natural gas that really is the foundation and backbone of human civilization. And look, these talking heads who are wealthy and in positions of power that fly their jets to Davos, they can't afford to double their input costs on oil and gas. A lot of people can't. And we've seen demonstrations in France around higher prices. There's a big conversation going on in Canada about what the right price for carbon is. And so these issues, I think, become stickier. And my view is that there's complacency in the U.S. based on a decade or more of fossil fuel subsidies and low prices that have come from overinvestment in the shale sector. Mm-hmm. And with that going away and rising prices, it will start to creep up as a political issue that even Democrats will have to handle when their constituents who are blue collar, who would otherwise be voting Democratic, look and see they're paying $3 and $4 at the pump. And it doesn't matter how you get there, whether you're taxing oil and gas companies and raising the marginal cost of production, or whether you're taxing them at the pump, it's still going to be a political issue when people start to see highly regressive prices. And it is in Germany for power prices, for example. I mean, they're the green revolution there has basically just produced two separate energy systems. You've got coal.
About 30%. I just checked, by the way. It's about 30. So they've done decently on the emissions for a number of reasons, but they have a lot of coal. Like they've got coal.
They got a coal power gen system, and then they've got a natural gas and solar system.
Yep.
And Alex Epstein would call that reliables and unreliables. And, if you look at what happened in Texas, clearly the entire system failed, but there was.
I don't think he's listened to Robert and I's podcast.
Should I have?
Yes, you should.
But the entire forecast was based on the presumption that renewables were only going to have a capacity factor of 20 or 30%. So you're starting at a deficit against things that run 80, 90% capacity factor, nukes and gas. And actually, look, this is an oil and gas focused podcast, but I believe that if climate was really crisis, you would see most of the climate activists talking about the importance of nuclear power. And instead, that community is divided among people that want to drive nuclear out and those who recognize that that's the best baseload power source for no CO2.
So this is why it's so important. And I do, I had some friends listen to the podcast and they paid some really nice compliments in terms of the content. And I really do. I want to give listeners information. So you can like it or dislike it and you can disagree with it. That's fine. But I really pride myself in like having a lot of facts and a lot of data and explaining it to people. And I think this energy transition thing, the reason this bugged me so much is because of that. So if it was about CO2 emissions, then you wouldn't, if the Biden administration, it's about CO2 emissions, then they are going to have to back off. And they may actually be backing off a little bit on oil and gas. We'll see if this Reuters article and what's happening with the, loosening or allowing permits to go forward. We'll see if that's actually real. That's not what I'm hearing in DC. I have not confirmed that. And I'm still concerned that nothing I'm hearing in DC is positive all on oil and gas. However, what bothers me is that oil and gas production is 1% of US emissions. So if it's about emissions, then it's not about the actual production. So then it would be about the end use. Well, then you would have to start off your administration by saying, we're curbing your end use of the product. And I don't think that's politically favorable. So you're not going to do that. And the problem is, and I've said this in multiple podcasts where I've been interviewed lately, is that the answer is, if this is about CO2 emissions, the answer is, I literally pulled up the data, and I know everybody says it. You hear it in oil and gas podcasts a lot. An energy podcast says that it's about China and India. It is. I'm sorry. It's about power and it's about coal and it is about China and India. So pull up the charts. Like, heaven forbid, BP has all the data. The data is out there. You can see exactly how much coal is consumed and how it's used. And in China, the fascinating thing is that, and I have been listening to, it's called Energy Transition Podcast, and I will invite if they want to bring me on the podcast, I'd love to be on it because they struggle a little bit in terms of some of the oil and gas talk. But if you want to learn about different components of the business, it's great. I still think there's a little bit of a bias, but this is an oil podcast, so we have plenty of bias as well. But they talk about China and how they do a really good job of explaining, like, they set a GDP number, right? And so China just came out with a 5-year plan, and we'll dovetail into this. But like, they set a GDP figure, and then they sort of the government basically sets it, and they let the local government municipalities like go hit it. And the part of that going to hit it is the big piece of like why they have so much coal-fired power generation. I'm not certain that they don't use all the coal-fired power generation they have every single day. They're not running it at full capacity. But if you just pull up, I mean, it was that UN figure is the same thing I'm seeing from the BP data that I just threw into my data system, is that China's CO2 emissions are like this. China's coal consumption is like this. And it's not just their coal consumption.
And for listeners, that was up and to the right.
Yeah, sorry. Up and to the right. I'm using my hands a lot. And then the US is declining. And the US, it's important to point out.
Why is the US declining?
Well, so if you look at the charts, we are definitely the second largest emitter. Like, India's coming up and they're on a straight upward trajectory, but they emit a lot less than we do from a CO2 emission standpoint. So we're the second largest emitter. And that's what everybody points out and why we need to work on this stuff. Except we've been on a trajectory declining for a decade. We've been declining in CO2 emissions. And you could argue, and I'm sure that politicians would certainly argue, that Trump didn't do jack to help on emissions. And yet the trajectory was still going down. It was going down, and Obama was going. So what is it? And it has to be that at the very basic level, it has to be that we swapped out a lot of coal for natural gas for power. That's it. And we still have, it's in terms of people think that oil and gas is like the low hanging fruit. It's not the low hanging fruit. Coal is the low hanging fruit. All you would have to do is take that $2 trillion of stimulus we had, and you could have went to China and India and you could have said, I'm just going to subsidize. I'm just going to do it for you. Let me just help you build those pipelines and swap some stuff. Sounds ridiculous, but honestly, if it was about CO2 emissions, I think that's what you would be doing. You would be going to China and India and you'd be saying, how can we work with you to reduce your coal consumption? And it's the reason you can't do that, that's not politically favorable. That's not politically viable. Also, it's really hard. When I'm talking about China setting their GDP targets and then the country's doing it, it's a huge piece of their economic growth story. One, it is reliable energy. It's secure, and they produce a lot of it. So India has a huge coal sector. And so it's a massive part of their economy. And it has went through decades of going back and forth. India they have some great podcasts as well on the energy transition. And they have went back and forth between private to public of being government-owned coal. And that has complicated the structure and made it very embedded within the Indian system. So to just go remove it or to say that China is going to leapfrog is crazy. The experts that I have at least listened to and the research I've done does not suggest that they are anywhere near removing coal anytime soon because it employs so many people. And there's kind of like a Indian mafia that's also part of the coal. It's very deep and it's very nuanced and it's very messy. China, I would say, maybe a little bit less so because they have the ability to sort of build out this infrastructure. India also does not have all the pipelines in place to just grab the gas. You have to develop a lot of that. And then China is working on that. But I mean, they also are concerned about security of supply. And so they import a lot of liquefied natural gas, but liquefied natural gas means that you have choke points around the world, just like you have for oil. And I don't think they want to be completely beholden to that. And so their recent 5-year plan that they just outlined, actually, I think the media's done. I don't know. I haven't heard Bloomberg or CNBC talk about it in any detail, but it's certainly disappointed. I think, at least if you're a hardcore academic and you're on the energy transition side, it's certainly disappointed from a green side.
Well, that is an excellent teaser for our next and subsequent follow-on podcast. Since we're out of time for this episode, we are going to stop here and we're going to maybe have a real drink, and then we'll come back for Part 2, St. Patty's Day juggernaut of Trisha getting wound up about things in the energy market, which
this is good. Yes, so we should have started this by explaining that we did explain the date, and this is a weekly podcast, but both Ethan and I are really busy lately, so we're going to do this as a Part 1 and Part 2 episode, and there's plenty to talk about, and the Guinness is actually pretty damn good. So, all
right, so we'll pause there, and then if you want to hear us talk about Chevron and the China 5-year plan, we'll come back in the next episode. So thanks for listening, and we're out.